If there was only one message I could share with everyone in the country to help them transform their financial future, it would be this. Your pension is one of the most powerful, tax-efficient ways to grow your wealth over time. It's the largest pot of money most people will ever build in life, and yet pensions are both neglected and completely underrated. Two things I see time and time again is that people either completely misunderstand the huge tax benefits or have high fees eating into their pension pot. I'm James, a financial educator from moneystalker.com. In this video, with the help of completely free tools from InvestEngine, I want to show you exactly why your pension is one of the strongest tools in your financial toolkit, and how understanding tax relief and fees could transform your retirement savings. What is a SIPP? Let's start with the basics. A SIPP, or a self-invested personal pension, is a type of pension that gives you full control over how your money is invested. Unlike a traditional workplace pension where your investment options might be limited, a SIPP lets you choose from a wide range of investments, whether that's ETFs, individual shares, or ready-made options depending on your provider. And just like other pensions, SIPPs come with the same valuable tax benefits, including tax relief on your contributions. If you've already taken advantage of any employer-matched contributions available in your workplace pension, you really should consider a SIPP to further boost your retirement nest egg. Now, let's talk about how incredible tax relief really is. This is essentially free money from the government, added to your pension when you make contributions. If you're a basic rate taxpayer, you automatically get 20% tax relief when you contribute to your pension. That means if you pay £800 into your SIPP, the government tops it up to £1,000. If you're a higher rate taxpayer, 40%, or an additional rate 45% taxpayer, you can claim an extra 20 to 25% back through your tax return, or you can submit a reclaim form via the Gov UK website. That additional amount comes back as cash, but could also be a tax code adjustment, and you can choose to reinvest it into your pension to give your pot an even bigger boost. To show you exactly how tax relief can shape your pension pot, let's look at InvestEngine's free pension pot calculator. Let's imagine someone earning £60,000 a year and they're adding £500 a month to their pension, which is £6,000 a year. Assuming a 7% growth rate, which is not guaranteed but an estimate based on historical performance, they could be a millionaire in 40 years' time when they retire. But look here, if they didn't have their reclaimed tax relief added to their investment pot, they might have over £250,000 less and not be a millionaire. That is the impact of tax relief. But not using tax relief is just one of the ways a pension pot can be severely cut in value. Another silent problem is fees. Using this same example, let's imagine the person pays a seemingly small 1% fee over time. Look again, their pension pot drops by another £200,000. Do you see now how not paying attention to tax relief and fees can cost you dearly? In this example, close to £500,000. InvestEngine SIPP automatically reclaims basic rate tax relief and minimizes fees too. That's because the platform is literally free. It's just the underlying ETF fees that apply. Not only that, but they have a free tool that helps you build a personalized plan, so you can see exactly what it might take to reach your retirement goals. Let's take a look. This tool helps you estimate how much you'll need for retirement based on your desired monthly income. Let's imagine a 25-year-old called Laura. She's aiming to retire at 60 years old. Laura is hoping for a long and happy 30-year retirement. She is earning £40,000 a year and anticipating salary jumps of 5% on average through her career. Laura is currently contributing 10% of her salary to her pension, and her employer adds 5% too. She currently has £10,000 in her pension pot. We're going to assume the state pension is still there from 66 to supplement her income too. We're going to use the estimate of 5% for our annual investment performance, which again is not a guarantee. We're comparing here with Hargreaves Lansdown, another investment broker. Look here, as things stand, Laura is on track. In fact, thanks to the low fees of InvestEngine, the pension pot would last them an extra 5 years. But if they were to go with a more expensive provider like Hargreaves Lansdown, thanks to them charging over £57,000 in fees, Laura would only have 27 years of retirement income, falling 3 years short of what is needed. In other words, Laura may need to work longer or save more every month of their life just to cover the fees of this expensive investment provider. Now, you might be wondering, won't Laura just be taxed on this money later? Possibly, But don't forget, 25% of the future pension pot will be tax-free. The first £12,570 a year is also tax-free when she draws down in retirement. The rest is taxed as income, and she'll possibly have a lower income in retirement and therefore be in a lower tax bracket. But by asking this question, you're overlooking a key point. By putting money into your pension, you're not just getting a 20% tax relief boost, you're getting what that money can become when it's invested. That extra tax relief, money you wouldn't have had without your pension, also grows and compounds over time. And given enough time, that seemingly small boost can snowball into something much bigger. That's the part most people completely miss, and this is why I feel so strongly about pensions. So if you're considering opening a SIPP, InvestEngine offers a simple, low-cost option worth exploring. The reason I'm here doing this video is that I have my SIPP with InvestEngine, and I believe they have the best product on the market, period. You get commission-free investing with no account setup or platform fees. The only costs you'll pay are the ETF fees themselves, which typically range from 0.07% to 0.25%, significantly lower than many other options. You can open a SIPP with as little as £100, making it accessible for those just getting started. It's easy to set up a savings plan for regular contributions, helping you stay consistent with your retirement savings. Plus, they have lots of cool tools like the pension pot calculator and SIPP calculator, which are completely free to use, helping you model your pension plan and understand your options in minutes. PS, they're working on their transfer range to bring more options to transfer to the platform. In the meantime, you can set up one for free and start contributing from £100. I hope now that you can see that the amount you have in retirement is shaped by more than just what you contribute. Tax relief can give your pension pot a major boost, while fees, if you're not careful, can quietly erode your savings over time. Planning early and taking a few minutes to use simple tools like the ones I used in this video can help you make more informed decisions and stay on track for the retirement you want. If you want to see how your pension could grow or how much you might need for your ideal retirement, check out the calculators linked in the description of this video. I really hope you found this useful. I look forward to seeing you again in the next video. Take care.